Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining us for this segment, we have Paul Baiochhi, chief ETF strategy over SS&C ALPS. We're going to take a look at his energy outlook. Paul, it's great to have you with us. Welcome to Trade Talks.
Thanks, Jill. Appreciate you having me.
All right, you got it. And how should investors be thinking about energy exposure in the context of the ESG initiatives and policy directing capital away from hydrocarbons and towards more renewable energy markets?
Well, I think it's important for investors to take a nuanced view of the energy transition and the impact on legacy energy companies, as well as the opportunity set for renewable energy companies. And it's important to note that you can't necessarily just position for renewable energy companies, and you can't necessarily position for the energy transition by ignoring legacy energy businesses, because it's many of the legacy energy companies that are going to be investing in technologies and improvements to our energy markets, while at the same time you look at the infrastructure for delivering various forms of hydrocarbon, whether it's crude oil or natural gas, to investors. And ultimately, those are also going to play a very large role in an energy transition. So the best way for investors to think about the transition and some future state of our energy markets is, who are the companies that are relevant now to our energy markets? Who are the companies that have exposure to some version of the transition, whether that's increased natural gas demand as a result of increasing electricity demand, whether that's companies who have exposure to legacy energy markets as well as having investments in renewable energy, but also figuring out ways to augment some of that legacy energy exposure with plays on wind and solar and fuel cells and the like.
You know, it's so interesting. It almost reminds me of the financial space. If you want to correlate the two, you have your legacy institutions, you have the fintech companies. One brings speed, one brings scale. And it's so interesting, Paul, to see that it's happening not just in finance, but also in spaces like energy. So it's just funny to see how the technology and the speed combined with the scale really seems to be the way to move forward here. So how does the prospect of sustained inflation and rising interest rates impact traditional energy stocks and clean energy themes?
Well, in some ways, it ties back to your analogy around legacy financials and fintech, because if you think about legacy financial firms, at least from a valuation perspective, they tend to find themselves, at least with the style box framework, on the value side of the ledger. Well, whereas a lot of these fintech firms are more growth oriented in nature. And the same can be true in terms of legacy energy companies and some of these renewable energy companies, in the sense that a lot of these legacy energy companies trade, at least from a style box perspective, as value stocks, whereas a lot of the renewable energy companies, whether they operate in storage or electric vehicle categories, operate on the growth side of the ledger. And so when you think about rising interest rates as a result of increasing inflation, if you're a growth company and your cash flows are further out into the future, and the discount rate by which you value that company is going up, that means that in theory, a value company is likely to be more impacted by rising interest rates, whereas a value company who in theory has cash flows that are nearer term now and in the near future should be less impacted by rising interest rates. And so in that way, when you think about value companies versus growth companies and combining the two, you get some offsetting dynamics around the impact of rising interest rates, which is detrimental to growth companies, all else equal, while at the same time, value companies historically having done well in rising interest rate and inflationary environments. And there are companies in various pockets of the market that might have a little bit more inflation protection in their cash flows, meaning there's either indexed to inflation in the case of some midstream companies or pipeline companies, for example, or even pockets of the real estate market where they have shorter term leases that can be reset higher. And so ultimately, it's about figuring out how you combine the two within an asset allocation context, but also understanding the various macroeconomic and valuation dynamics that impact companies as it relates to increasing inflation and increasing interest rates.
So Paul, when we look at this space, let's say 3 to 5 years out, what do you think it could potentially look like when we think of renewables, more of the ESG push within energy? What does it look like?
Well, it certainly looks like companies who are able to provide significant progress in terms of the ability of batteries to store electricity and energy generated by, say, wind and solar, because we certainly are subsidizing wind and solar adoption, and wind and solar are growing in terms of their contribution to our electricity generation. And so as battery technology improves and the companies developing that battery technology improves, it makes those technologies a little bit more useful in terms of reliability within the context of energy. But if we're going to, for example, subsidize the adoption of electric vehicles and therefore increase electricity demand as more people are plugging cars into their garages and into these electric charging networks that we're proposing to build around the country, that means we need likely more natural gas, because all else equal, it's the most important electricity input that we have. And until battery technology is where it needs to be, storage technology is where it needs to be, wind and solar really aren't in a position to pick up the slack of a declining share of coal and declining fossil fuel contributions to electricity. So in many ways, 3, 4, 5 years out, more electric vehicles on the road, more demand for electricity, and therefore likely more demand for natural gas, which happens to be very abundant in the United States. And therefore the companies who are tasked with moving it, storing it, processing it, and delivering it to places where it can be consumed have a really large role to play as well.
Right. And Paul, it's interesting that you say that, because there's this narrative out there that we need to fix the environment now, we need to think about climate change now and so forth, but it's not a light that you can just switch on, pardon the pun, to, you know, the EV space that we're talking about there. But this takes a lot of R&D and science and the correct skill set from the workforce and to be able to implement these things. So it's not something that just happens overnight, because that narrative is out there. And I think that's important for investors to understand.
Without a doubt. And you think about pipeline companies as one example, and it's a segment of the market that we focus on because we have ETFs focused on midstream energy infrastructure, AMLP and the NFR. But ultimately, pipelines right now are typically moving crude oil and natural gas through their networks around the country and storing it and processing. But in theory, because the moniker is infrastructure, they're going to be asked to figure out how to build networks to move carbon dioxide around the country, to move hydrogen, renewable natural gas, renewable diesel around the country. So you can sort of see where I'm going with this. Companies that on the surface seem like bad words because they're fossil fuel companies in this world where we want to get away from it, are actually going to have a really large role to play in ensuring that we can transition away from a high dependence on coal, on crude oil, on natural gas, and allow for the effective, efficient sequestration of carbon dioxide, the transportation of hydrogen and renewable fuels around the country. And that's what's ultimately lost in the binary conversation about renewable or fossil fuels. In many ways, we need some combination and a thoughtful combination of all of these things to progress us forward to a future where we are more cognizant of the impact of all of these things on the climate and on the globe, but ultimately also leveraging the expertise of companies that can contribute meaningfully, but it on the surface might not seem like they're aligned directly with some of these renewable mandates.
All right, Paul, we appreciate the insight. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.
Thanks, Jill. Have a great day.